Well, hello, and welcome back to Principles of Accounting 1. I'm your host, Dr. B. We are currently in the 6th week of our Accounting 220 course. Let's talk real fast about where we were, where we are, and where we're going. We had just wrapped up week 5. Week 5, you had your second more so major exam, which covered content from weeks 3 and 4, and a little bit in 5. You also had your discussion forum and your homework assignment. That was week 5. That's where we were. Where we are now, we are entering week 6. Week 6, a little bit different than previous weeks, but not by much. In week 6, you'll have your weekly homework assignment that will cover the content that you'll learn this week. You'll have your standard weekly report, but the primary difference here is in the discussions. The discussion is a draft of your PowerPoint presentation for the 10K project. That is the discussion requirement. So what do we mean by that? So as you know, one of the requirements for the project is a PowerPoint presentation. Doesn't have to be long. It could be as short as 10 slides, thereabouts. It could be longer if you like, shorter if you like. The point to the PowerPoint presentation is you are, in theory, presenting the information you have discovered through the 10K project process to the board of directors, if you will, for your respective company, for the company you selected. The idea behind it is you want it to be attractive, informative, and actionable, right? That's it. That's the whole idea behind a PowerPoint. Attractiveness would include a theme. You might want to consider the idea of doing like a voiceover. You could use the voiceover feature in PowerPoint, or you can do something like Loom, or you could even create a YouTube video or whatever, right? The idea behind it is that you're basically presenting. That's a nice touch. You don't have to go that far, but it would be beneficial if you had a way to present the PowerPoint presentation, right? So think about that as an option. And in the 10K PowerPoint presentation, as you're going through and you're drafting it, try to include as much information as you've gathered already based off of the past 6 weeks. Through your discussion forums, through your project writing. Hopefully, you're working on the report as you're going along, but think of a nice creative way to draft that. And that's the whole idea. And try to do that one a little bit earlier in the week. My recommendation for success in the PowerPoint 10K PowerPoint draft is try to get it done and in the classroom, I would say by Sunday. The reason why I say that is because you want to try to solicit feedback from your colleagues, your classmates, and that feedback and my feedback. Of course, I'll give you feedback as well. Is the idea behind it is that you take the feedback, you incorporate it into your presentation, so that way, come week 7, you're ready to go with your submission for the project. So that's kind of the idea behind it, and that's what makes this week a little unique than others. So that's where we are. Where we're going next week is week 7. The 10K project is due. 10K project includes the 10K report, the 10K PowerPoint presentation, and that's it for the 10K. Then, of course, you have, in addition to that, a homework assignment you have the third exam, and you have the report. So it's a really busy week next week. If you want to, and you're more than welcome to, try to work ahead. I would encourage you to work a little bit ahead, because so that way, come next week, you're not swamped. You're not in that 11th hour trying to hustle it out. I try to avoid that type of stress. So my advice would be to try to work a little bit ahead wherever you can. And that's where we're going. Okay, so having said all of that awesome stuff, let's jump into the content for week 6. And we'll talk about a couple of interesting concepts in accounting. So the first part about this week is around partnership accounting. Now, partnerships, as you would imagine, are a form of a business. A partnership is between two or more people that are engaged in economic transactions within a business. A partnership could be a simple partnership, an LLC partnership, a C Corp, an S Corp. It's basically a form of business ownership, right? And the concept behind that that a partnership formation, is that the partners are both mutually responsible for the business, both profits and losses, and taxes, and assets. You see where we're going with this. So the list goes on and on. The idea behind the partnerships is the partnership, in essence, kind of limits the partners within the business to the point where they are responsible for their percentage of ownership in the business. With partnerships, there's no set percentage of ownership that each partner has. What do I mean by that? You could have two partners in a business, and one partner might have 20% ownership and the other one has 80% ownership, right? And there's no like set percentage, so to speak. The percentage ownership is typically, and I mean typically, derived by the amount of the initial investment that each partner brings into the business. And that's typically how that part works. And that is governed by the Articles of Incorporation, which we'll talk about here in a second. Before we jump into the Articles of Incorporation, I want to touch on the different types of partnerships. You have an LP, LLP, S Corp, and LLC. These are the most common partnership forms of business. Limited partnerships. The nice thing with limited partnerships is it limits your liability. What we mean by that is you as a partner do not have any type of liability beyond your initial investment. So if you start a business with a friend of yours and you're like, I'm going to throw in $100 into this business, but that's all I'm going to throw in, you're only liable up to that $100. That's just a very, very simple example, but that's a limited partnership. But there's also, of course, a limitation. It works the other way too, right? You're not just limited on the liability side, you're limited on the asset side as well. You're limited to what you bring into the business. With respect to a limited liability partnership, this is, how do I put this? This type of organization in business protects partners from malpractice. There's typically a malpractice insurance, also known as an umbrella insurance, that the organization takes on to protect the partners. That's very common. It's also typically itemized in the articles of incorporation. And in most states, partners can be held personally liable for partnership debts. That is very common. For example, if we have a business partnership and one of the partners takes a loan from the company, they are essentially, in theory, liable for that loan to the other partners because it's a partnership business, right? So everyone takes ownership and liability in the company. So if you take assets out of the company, you're responsible for repaying those assets. So that's why you're personally liable from that perspective. That's very common. With an S corporation is very similar in nature with limited liability partners when it comes to liability. However, with an S corporation, it's typically for larger partnerships. Think of like a law firm as an example. A law firm has a lot of lawyers that are partners of that organization. That is, again, very common. That type of firm was probably going to be an S corporation because S corporations are typically for larger partnerships like a law firm or any other business where there's multiple owners. And within that type of situation, it's treated as a partnership for income taxes, which typically pass through. And they have the same limitations as a C corporation. Now, the thing with S corporations is the amount of ownership or percentage of ownership is expressed in stock. But it's typically preferred stock is how that is organized. And we'll talk a little bit more about that in a couple of examples. And the fourth most common partnership type of organization is a limited liability company, LLC. Very, very common for partnerships. In fact, that's one that I had in the past. And it was an LLC. With an LLC, it protects you, the owner, from malfeasance, right? There's limited liability. That's the whole idea behind it. So, in other words, no one's going to go after your personal assets in the event of a lawsuit or anything else going wrong with the business. They'll only go after the business's assets. That's why it's treated as a corporation, essentially. With a corporation style business, a corporation is kind of the way to think about it is a corporation is its own person. Okay. In other words, let's say Joe and Rod are partners and you guys own a business together. Okay. And your business is an LLC. And I'm your customer and something goes terribly wrong and I sue the business. I'm not suing Joe and Rod, I'm suing the business, right? And so Joe and Rod are protected through the LLC. Their personal assets are protected, and I can only go after the assets of the business, right? And so with that, it's treated as like a corporation. A corporation is its own entity, and also from that, with the LLCs, because it's treated as a corporation, typically the LLC is the one that pays taxes, not the individual partners. And we'll talk a little bit more about that concept. So as I mentioned with the LLC, well, it's technically passed through in terms of taxes, but the good news is we don't get too far into taxes in this type of course. For those of you who are accounting majors and you'll eventually be taking federal taxation later on, that is something that you'll be diving a little bit deeper into. In 221, we don't go too deep into taxes, but we will a little bit in this class from a payroll perspective. We'll talk more about that. So when it comes to partnerships, partners can invest personal assets into the business and liabilities into the business. In other words, if Joe and Rod are partners, and Rod comes in with machinery for the business, that is an asset, of course, and that would be classified as owner's equity because it's Rod's machinery. He's bringing it into the business. And so that would be Rod's investment. And then Joe comes in with some cash, but he also comes in with some debt that he got to get that cash. So you're both bringing assets and liabilities into the business. And we record pretty much everything at market value. That's the cool thing about these types of partners, or about any type of partnership, is the partners typically bring in the assets and the liabilities into the business, and they're also responsible for those. But it's typically at a percentage. So let's look at an example. So we have this company that's organized as a partnership. The partners in one partner here invested. Let's see, what did this partner invest? This first partner invested $7,000 in cash, $33,000 in boarding facilities, whatever that is. I imagine that's a building, and they also are bringing a loan for that facility. So when we're setting up a partnership and a partner is coming into the business, we record a general journal entry to record the investment of that owner. So the owner's bringing $7,000 in cash, so debit cash to increase cash. The owner, I assume this is like a building. You debit the building account, boarding facilities, $33,000. Maybe it's a horse farm, who knows? Debit $33,000. They have a loan that they used in the purchase of that building. So credit notes payable to increase notes payable, $10,000. And we credit capital investment of $30,000. Now, your question might be, well, how did we derive 30,000? Okay, you might be asking. So in looking at what the owner brought in, this new owner brought in $40,000 in assets, cash in a building, right? 7 plus 33. So 40,000 came in assets, cash in a building. The owner capital investment is only 30,000 because the owner also brought in a liability of 10,000, right? So 40,000 minus 10,000 is 30,000. So assets minus liabilities equals equity, right? That's and as you know, that's another way of writing the accounting equation. Assets minus liabilities equals equity. So if you think of the I don't want to say basic math because I don't know what math class it would be, but when you rewrite an equation like the accounting equation, as you know, is assets equals liabilities plus equity. If I wanted to rewrite that equation, I would say assets minus liabilities equals equity. Okay, and you see how the sign, the change from a plus sign to a minus sign as it went to the other side of the equal sign. That is the way that you would rewrite the accounting equation if you're trying to figure out the owner's equity. So assets minus liabilities equals owner's equity is the other way of writing the accounting equation. So if you saw a question, wink, wink, on a homework assignment that said, find the capital, find the owner's capital, you would say assets minus liabilities equals the capital to find that answer, right? And we have another partner that is coming into the business with $10,000 in cash. So you just debit cash and credit capital to that partner. And when you see capital, by the way, of course, what we're referring to owner's equity. Those are owner's equity accounts. Okay, so there's a lot of like accounting things going on with partnerships. Anytime that the owner takes money out of the business for whatever reason, it could be a distribution of sorts that all the owners got, $10,000 because of whatever reason. That's called a distribution. And when there's a distribution, you debit the distribution account and credit cash, right? But that is to account for any withdrawals from the partners that the partners make from the business. Capital accounts are credited or debited based on the shares of net income. That's percentage of ownership when the accounts are closed at the end of the accounting period. And partners, if there's a closure of a partner account for whatever reason, the partnership got dissolved, one of the partners left the company, there's a separate withdrawal entry that's made for that as well. I'll just show you a couple of examples of what those look like. Okay, how are the partnerships divided up? Okay, so that depends. There's no straight answer for that. It could be 50-50 if there's two partners, if the partners decide on something like that. Like I said before, it could be 20-80, it could be whatever percentages for each partner. And those are, again, typically based off of what the partners are bringing into the business. So what we do in accounting, at the end of the accounting cycle, when we're closing out our temporary accounts and we're reconciling our book and we're making our closing entries. In that process, we are also accounting for the income or loss and attributing a percentage of that to the respective partners. And we do this based off of three allocation methods. One is ratio method. Another is the capital balance, the balances essentially, and service capital and stated ratios. So here's an example of that, of an allocation using a stated ratio. In this partnership agreement between Zane and Perez, Zane owns 2/3 of the company. Perez owns 1/3 of the company. And so in that, we are allocating the income from the business to each partner. So it's relatively straightforward. You take the total income, the net income, and you multiply that by the percentage of ownership. So for Zane, for example, $60,000 net income times 2/3, or 0.3, I'm sorry, would be 0.66. 60,000 times 0.66, looking at 40,000, 2/3, right? For Perez, since he owns 1/3, 60,000 times 0.33. or 33%, is at 20,000. And that is how we would allocate the income to the partners. And that's part of the closing process. So what if we did it based off of the ratios? Let's take a look. We had, okay. So if we look at the allocations, let's say, and of course, this example is obviously ratio based. There's a beginning balance, right, for that for each partner. 30,000 for Zane, 10,000 for Perez. Now remember that the 30,000 came from Zane brought in a building, brought in some cash and a loan. That's how we got the balance 30,000. Perez brought in 10,000 in cash. You can rationalize or allocate the revenue, or I'm sorry, not the net income through ratios. So if you had 100%, 75% goes to Zane, 25% goes to Perez. How do we come up with those figures, you might be asking? Well, we have a total balance of 40,000. 30,000 came from Zane, 10,000 came from Perez. That is a 75%, 30,000, 25%, 10,000, of course. Then we have income, the net income, 60,000. So how much would we allocate to each partner? Well, we have 60,000 total, right? So if you can take your 60,000 times 75%, that's 45,000. 60,000, 25%, 15,000, and those would be your allocations for each partner. And the journal entry, the general journal entry that you would make as a part of the closing entries would be a debit to income summary and a credit to each respective capital partnership account. And so what that does is it closes out effectively your income statement. That's why it's part of that closing cycle. Now, there are always, I mean always, agreements between the partners. The partnership agreement basically dictates or governs, I should say governs. The partnership agreement governs the business and how the partners interface within that business. In some cases, not all, partners may opt to have a salary allowance, okay? Partners may opt to obtain a percentage of interest. Partners may opt to have a stake at a remaining balance. And so these are basically conditions that the business has based off of the partnership agreement. And the partnership agreement, it basically classifies how the business is to be allocated. Now, in this particular agreement, we have an allocation for interest, an allocation of net income, and they have salaries, okay? And that's based off of their agreement. So based off of that agreement, it told us that the partners get 10% of the interest amounts. They get, what was that, 50% of the equal allocation. And so this is how we can derive the income that each partner would receive. They have their respective salaries as outlined in the agreement. They have 10% interest. So that 10% interest is coming from the difference in salaries. So we started with net income 70,000 in this example. I thought it was 60, but 70,000 in this example. 70,000 minus the total salaries gives us a difference of 10,000. That and then we have interest, 3,000 and 1,000. Coming from the 10%, 30,000 and 10,000, and those are based off of the balances that they brought in, right? The 30,000 and 10,000. So 10% on the 30,000 investment, 3,000, 10% on the $10,000 investment, 1,000. So we take the 10,000 minus the 4,000, giving us 6,000 remaining. And according to the partnership agreement, they split the balance. And so 3,000 and 3,000 respectively. And we can see just based off of this information that Zane is receiving a higher income in comparison to Perez. And that's based, of course, on the percentage ownership. So it's not as simple as it sounds, right? It's definitely different. So let's assume that we had a lower net income. It's like, okay, it's all fun and games when you're doing well, but when you're not doing so well, there's going to be a difference, right? So because according to the agreement, their salaries are fixed. So you can't go in revising their salaries. It doesn't work that way, right? So if we had a net income of 50,000 in that 1 year, Zane still has a salary of 36. Perez still has a salary of 24. That gives us a balance of minus 10,000. So 50,000 minus 36 minus 24 is negative 10,000. Then you still have interest based off of the capital that they brought into the business. Zane still gets his 3,000. Perez still gets his 1,000. So now you're minus 14,000. What does that ultimately mean? Well, just as it is in good times as it is in bad times, the owners have to split the loss. So if there's a loss of 14,000, they get to split minus 7,000 each, reducing their total income for each partner. So that's what makes partnership accounting fun, right? So here's the report. This is what the report ultimately looks like. Just kind of give you an idea of how it all looks in a nice report format. Yeah, so it's an interesting concept. It really is. And there's a lot of interesting things that happen with partnerships. You could have new partnerships come in. You could have partners leave. And when there are differences, we, of course, need to account for those differences just like we did when we created the business. You'll have purchasing from other partners, investing in assets from partnerships. When a new partner comes in, they can purchase a partnership interest directly from the existing partners. In other words, let's say you got Zane, he's at 75%, you got Perez at 25%. Let's say Joe comes in and he's like, hey, you know what? I want a piece of this action. I'll invest some money into this business. And so Joe will say, hey, you know what? I'll buy a percentage of the business from each of you. And that would, of course, change the dynamic. And that's a very common thing. And so the cash goes to the partners, not to the business, to purchase their shares of ownership in the company. And that's really common. So Rashid came in, and Rashid is a new partner, and Rashid bought $13,000 in shares from Perez. And so Rashid comes in as a new partner, and we could see how it gets the allocation changes. The balance before the new partner for Perez was 26,000. The balance for Perez after the new partner, since Rashid bought $13,000 worth of shares from Perez. Perez new balance 13,000, and Rashid balance 13,000. Zane still at 52. Total still at the total still at 78. There's just a shift in ownership, right? And so with that, you debit Perez's account 13,000 to reduce his capital account, which, as you know, is a owner's equity account. And you credit Rashid's capital account, which is a owner's equity account, by that same amount. And that journal entry reflects that change in ownership, or that shift in ownership. And there's a lot of other very detailed examples, but we're not going to go too deep in this class. That is definitely for an advanced accounting course, which this is not. This is principles. But this just kind of shows us those examples, right? And so Rashid now owns 13,000 worth of the business that he bought directly from Perez. And Rashid is also bringing cash into the business, which increases ownership, Rashid's ownership in the business. So Rashid decided to invest $22,000 of his money into the business, debit $22,000 in cash to increase cash, and credit $22,000 Rashid to increase Rashid's share of ownership. And now the balance of the business of capital within the business is 100,000. So that's investments into the business. Now, what about withdrawals? Withdrawals can be taken for pretty much any reason. I mean, of course, you have to give a reason to your partners when anytime you take money out of the company. But the idea behind a withdrawal is that you're taking ownership out of the business. Okay. The most common form of withdrawal from any type of partner is typically in the form of what we call a distribution. Distributions are very similar in nature to what do you call that when you pay a stockholder? A dividend. A distribution is very similar to a dividend. Very similar. It works the same way, in fact. The difference between a dividend and a distribution is a dividend goes to a shareholder as a form of interest, right? A distribution goes to the owners or the partners as a share of ownership, of interest of ownership. And that's very common. So that's reflected in number one. And number two, the partners can simply take out cash for whatever reason, right? It could be a personal reason. Maybe it could be a loan from the business to the company, or from the business to the partner. There's a lot of different reasons for it, but of course the partners need to agree before something like that happens. So here's an example. Perez looks like he's taking 38,000 for whatever reason out of the business. So of course, what does that do? It reduces Perez's ownership of 38,000. And why is this happening? Well, it looks like Perez is leaving the business entirely. Okay. So to record Perez leaving the business, we debit 38,000 and we credit cash 38,000. Of course, we're paying Perez the 30,000 in cash from his initial investment into the business. Why 38,000? I thought Perez only brought in 10,000 in cash, right? Well, remember that the new partner bought shares from Perez, and what else happened? There was some other stuff, obviously, and so this is the transaction that we make to withdraw a partner from the business. So the 38,000, where it came from, 34,000 in cash, a 2,000 investment coming from Zane, 2,000 investment coming from Rashid, 38,000 is coming out of Perez's account, and the difference is being made up by the other partners for whatever reason. Oh, it looks like a bonus. It was a bonus. That's nice. It's nice to get bonuses, especially when a partner leaves. Okay, so when Perez is leaving, the other partners share in the income and loss equally. That's the whole idea of a partnership. You share in income and loss. So with Perez leaving, the other two remaining partners would reduce their equity based off of any type of loss. And so this is what that loss would reflect. And then, of course, cash going out to Perez. And that's what bonuses. Gets a little muddy, but you don't have to worry too much about it. The reason why I'm showing you this is because it's important to understand the concepts behind partnerships and how we account for changes that happen within partnership organizations. Liquidation. So the partnership decided to dissolve. They're going to go out of business for whatever reason. Remember, going out of business, that doesn't always have to be a bad thing. When you go out of business, it can be you're retiring, you've decided to do another venture. Something happens to one of the partners. Life happens, right? So there's a lot of reasons why a business would liquidate and close up shop. And so with that, there's typically a sale of assets. The assets come out of the business, go back to the partners. All of the liabilities are paid off, and any remaining cash goes to the partners based off of their percentage of ownership. So in our earlier example, let's say the partners couldn't agree with Perez leaving, and so they decided, hey, let's just dissolve the partnership entirely. So here's an example of what that looks like. So before the partnership is dissolved, we look at the balance sheet and we analyze the balance sheet. We got $178,000 in cash, $40,000 in land. We have an accounts payable of $20,000, and then each partner respectively has their remaining balance in equity. So we would need to satisfy that $20,000 liability before we do anything else. Now, of course, the most logical thing to do would be to take that out of the cash. But before we did something like that, we'd probably need to sell the assets. So let's say we sold the land for $40,000, and there was a gain from the liquidation of $6,000. So we got $46,000 of cash coming into the business. This was before the liquidation. That gain on the sale of the land is the first thing to be distributed to the partners based off of the partnership agreement. It's all equal, so each partner gets $2,000. The partners then need to agree to pay the liabilities. So they pay their accounts payable $20,000, reduced to $20,000 in cash. So we had an increase in cash from the land sale, then we had a decrease in cash from the payment of the accounts payable. So now that the accounts payable is paid off, we have a remaining balance of $204,000. So based off of the $204,000 remaining in cash, we distribute based off of the percentage of ownership. So $72,000 goes to Zane, $68,000 goes to Perez, $64,000 goes to Rashid. And that's how you would dissolve a partnership. Capital deficiency: in the event of the business not having enough capital in a partnership, the partners need to make up the difference. Okay. Yeah, that happens from time to time also. But of course, when a partner makes up the difference in capital, in other words, the business running out of cash. So the partners come together, they say, okay, we gotta drum up some more cash to keep this business going. So when that happens, when there's a deficiency like that, the partners make up that difference. Now, when they make up the difference, like for example, you see 3,000 Rashid brought in to make up the difference for some type of debt deficiency. When that happens, Rashid gets the credit, right? So the cash comes into the business, but also Rashid's owner's equity goes up by that same amount because he's bringing in cash into the business. And then, of course, then the deficiency is paid out to the remaining partners. Quick ratio. I know. Here's a good ratio for you. This ratio is pretty good because it tells us the percentage that each partner would receive based off of equity. And to find that ratio, we take partner net income divided by average partner equity. To find partner net income, we go through the process that we earlier explored by looking at the net income minus any cash distributions. And then to find the average partner equity, you take 100% divided by the partner investments, right? So we got where are we? Okay, sorry. So you take the income divided by the beginning of the year plus the end of the year divided by 2 to get the average. And that would give you the total percentage for the partner equity. That percentage is then broken out across the partners based off of their respective percentages. You don't have to worry too much about that one. It's just good to know. The next section that we're going to talk about in this week is notes payable. Notes payable, as you know, is a liability. Notes payable is typically a long-term liability because it's a liability greater than 1 year. Before we jump into long-term or notes payable, you need to understand the concept of current liabilities. Current liabilities, as you recall, are liabilities or debts owed by the company to anyone unless that's due in less than 1 year. That's a current liability. Example would be accounts payable, right? Taxes payable, payroll liabilities, or payroll payable, payroll taxes payable. The list goes on, right? Those are short-term liabilities, right? That's what current liabilities mean. There is this is where it gets important to understand this concept. With any long-term liability, like a note, there's going to be a current portion of that long-term liability. So think of a mortgage as an example, okay? For my mortgage, a 30-year loan, that the year that we're in right now is the current portion of that long-term debt, okay? So every next 12 months is considered the current portion. So my current portion of my long-term debt runs from June 2021 to June 2022. That's the current portion of my long-term debt. So if you think of it that way, when you hear current portion of long-term debt, think the next 12 months that it's owed, right? You already know what accounts payable are and accruals. We're not going to dive too deep into that, but I do want to talk about the short-term notes payable, and we'll talk about long-term notes payable. Short-term note payable. It's a short-term loan. it's usually attached to a high interest rate. That short-term loan is usually used by businesses to purchase inventory or other assets, typically. And the business pays those short-term loans, just like it would with anything else. Another thing with short-term loans or short-term notes is also on the customer side. Sometimes we have a customer that doesn't pay their bill. Okay, due 30 days, they're no show. Due 60 days, no show. Due 90 days, no show. 120 days, 121, 180. Right, the customer is not going to pay. So you convert their accounts payable to a notes payable. What that does is, you get a hold of your customer and you say, listen, customer, you haven't paid me in 90 days. Obviously, you're having trouble paying me. So what I'll do for you is I'll convert your account payable into a note payable. And with a note payable, as you know, with any type of note or loan, there's an interest rate associated with it. And those terms are expressed. So in this example, we have a customer that hasn't paid us. So we're going to convert their accounts payable to a note payable. We're going to issue a 90-day note payable on a 12% interest. They owe us $1,000. That's their principal balance. So $1,000 principal balance, 90-day loan, 12% interest. So debit accounts payable to reduce the payable. Credit note payable to increase note payable. The 90 days goes by, the cost, and so it's got to get paid. Okay, so on the customer side, they would record the note like this: debit note payable to reduce the note payable. Debit interest expense to increase interest expense. And you credit cash to reduce the cash. Interest is $30. How we got $30? $1,000 face value or principal amount times 12% times the 90 days divided by 360. You're probably wondering, well, why divide by 360, not 365? That is because there are 360 banking days in a year. 360 banking days in a year. There are 5 bank holidays throughout the year. I think it's changing soon, but that's what it is currently. Okay. With any note, there is a borrower and a lender. That's very obvious. The debtor is the borrower, the creditor is the lender. Companies can borrow from banks, individuals, other businesses, but in most cases, especially for a short-term note, companies typically borrow from banks. So let's assume that we have a company and our company took out a $4,000 loan to purchase inventory. Okay. And so we took out a $44,000 loan. It's a 90-day loan, so short-term now, so 3 months, 15% interest. Oh my God, I would never do that, but I'm just saying, okay? So the first transaction, we're receiving the cash from the bank. We debit the cash, $4,000, credit notes payable, $4,000, and then we attach the note, yeah? So the 90 days goes by. Now we got to pay it. Debit notes payable, $4,000. Debit interest expense to increase interest expense, $150. How we got $150? Principal amount, $4,000 times interest rate, 15% times 90 divided by 360. Remember, 90 divided by 360 represents the number of banking days. Okay. In other cases, the short-term loan can be expressed as a discount loan. very different. Okay. A note payable, a note payable is a simple loan, right? A discount note payable is a little bit different. A discount loan payable, instead of, and here's how it works with a discount, instead of having an interest, it's called a discount rate. Instead of instead of you receiving the face amount, you're receiving less than the face amount. That's the discount. Okay. That discount's expressed through interest. Okay. So here we are. Our company decided to take out a loan, a discount loan from the bank. Okay. For $20,000 loan, 90 days, discount note, 15% interest rate or discount rate. It works the same way as a regular note does, except we are accounting for the interest expense up front. This works, we're accounting for it at the time we're receiving the cash. But you'll see that I'm only receiving $19,250 from the bank, not the $20,000. The reason being is because it is a discount note. So the amount of cash I receive is the principal minus the interest. That's the amount of cash that I would receive. Okay. So the first entry is debit cash for the cash received, not the principal amount. Debit interest expense, credit notes payable. Now I still have to pay that loan back. I owe the bank 20 grand. Okay. So when I pay the bank back, I debit notes payable 20,000, I credit cash 20,000. So that's discount note. There's another one. This one's long-term, okay? Now we're jumping into long-term. Long-term. Long-term loans, long-term notes are also called installment notes. Installment notes. An installment means that it's the same amount for a period of time. Okay. Example would be your car loan, your mortgage, a lot of other loans. It's the same amount over time. Okay. It's a fixed rate. It's the same exact amount. Doesn't matter, making extra payments, making whatever. Same amount, same time. Okay. Installment, same amount, same time for the life of the loan. These are typically used in business to purchase property, plant, and equipment, just like it is in your personal life, right? It's the same concept. Requires you to, the installment note require periodic payments over the life of the loan. It includes, it typically includes a, what do you call? A promissory note. Promissory note typically includes initial amount borrowed, the interest rate, amount outstanding, the terms, so forth and so on. These are all expressed in the installment note documents. And these installment notes are expressly used to purchase property, plant, and equipment. And of course, there are terms. If the borrower fails to make payments, so forth and so on, they can be repossessed, yada, yada, yada. Installment notes are secured typically through an asset-backed security, like a mortgage. The idea behind an installment note is that there is collateral, usually the building. When a bank issues the loan, it's called an issuance. You debit cash of the amount of the loan received, and you credit notes payable. Here's another example. Here's the issuance. Okay, so the bank's giving me the loan. Great, wonderful, awesome. I debit cash the face value, 24,000, and I credit notes payable, 24,000. Principal amounts 24,000, interest rate 6%, term of the loans 5 years, annual payments $5,698. Okay, so the annual payments are also called periodic payments. Okay, periodic payments. Annual payments are called periodic payments. And so I need to make a payment of $5,698 every year for the next 5 years to repay that initial balance plus interest. It makes perfect sense, right? So, so I make my periodic payments. And when I make my periodic payments, I debit interest expense, 1,440, and I debit notes payable, 4,258, and I credit cash, 5,698. You're probably wondering, oh, Dr. B, how'd you figure out the interest and the principal? Well, and it's pretty straightforward. So if you go back to this screen here, initial balance was 24,000, 6% interest, 5 years, 24,000 times your 6%, divide that by 5 years, gets you 5,698. Now, how do we figure what portion of this 5,698 is principal, what portion is interest? Well, you can simply just go back and take your, oh, sorry, I went the wrong way. You could go back, take your initial 24,000 divided by that 5 years to get you your principal amount. Yeah, and obviously the difference is going to be interest. There's a couple ways of calculating it, really. One of the best ways is with a financial calculator. Okay, now I want you to observe something. And this process is called amortization. Amortization. When you amortize a loan, the principal balance and the interest change over time. Okay. The interest percentage remains the same, but the principal balance changes. So if I have a $24,000 loan and I subtract 4,258 from that 24,000, it's going to change, obviously, my balance going forward over the remaining years. That's why we see these changes. And you do that until it's paid full. Okay. Let's look at some factors. With these types of transactions, we have this thing called contingent liabilities. Contingent liabilities are expressed as likelihood of something happening. And there's a measurement associated with that estimation of something happening. Contingent liabilities, we use this typically when we look at a customer and saying, what's the probability that this customer will not pay me? That's likelihood. And how do we measure what's the estimation that that customer won't repay me? Those are called contingent liabilities. When something is probable and estimable. I'm going to try that again. When something is probable and estimable, I think I said that right that time. These are called contingent liabilities. The liability is recorded by debiting the expense and crediting the liability. Now, here's a good example. And this example is also going to help you on your homework assignment. Warranty. A warranty. You have a warranty on your washing machine. You have a warranty on your dishwasher. You have a warranty on your car. You have a warranty on your whatever, right? It's called a manufacturer's warranty. And usually that manufacturer warranty tells you, hey, within the first year or two, sometimes 5, sometimes 10. If this machine breaks down due to mechanical failure caused by design, you can file a warranty claim. And so what companies do is they estimate the probability of a warranty claim. And so typically they'll say, oh, 5% of all of our warranties that we've issued are probable or estimable that we will have to pay out, right? And so the company will take a percentage of all of their sales to estimate their warranty expense. So in this case, $60,000 for what appears to be a 3-year warranty. 5% of the sales price is what they factor as their expense, as being probable, right? So debit, warranty expense; credit, warranty payable. And what that does is it identifies the estimation of the warranty repair. And then when it's actually performed, when the warranty is actually performed, we debit product warranty payable and we credit cash. And you can do the same thing with parts, right? So let's assume that there were parts replaced under warranty, $200, debit, product warranty payable; credit, supplies being the part itself. Okay, a few ratios that I want you to understand as we are talking about liabilities. There's the working capital ratio, current ratio, and quick ratio. And I'm sure you've probably seen these before, but I'm going to recap them because they're that important. They'll come up again. Working capital. Working capital is current assets minus current liabilities. Again, all these are balance sheet accounts. The quick ratio is current assets divided by current liabilities. These measure the company's ability to satisfy its current liabilities. That's what these ratios tell me. Does the company have the ability to pay its current liabilities? Now, this ratio also very important. It's called the quick ratio. Quick ratio tells me how quickly the company can turn their assets into cash in order to cover their current liabilities. And that ratio is quick assets divided by current liabilities. Quick assets are assets that will be quickly converted into cash, except for inventory. So that would include things like cash, temporary investments, and accounts receivable. To illustrate this example, we have this following information: current assets, current liabilities for this company. We can calculate the working capital, current assets minus current liabilities, 3,780. Current ratio for this company is 1.7. With current ratios, anything above 1 is considered good. Anything above 1 is considered good for current ratios. So current assets divided by current liabilities. The quick ratio, as I said earlier, is quick assets divided by current liabilities. In this example, cash, investments, and accounts receivable are your quick assets divided by current liabilities, 1.3. Anything above 1 for the quick ratio is considered good. Anything above 1 for the quick ratio is considered good. Wasn't that cute? Okay, and on to our last topic for today, payroll. Payroll is a fun accounting concept. It's easy. It's easy for most. It's straightforward. Let's put it that way. It's very straightforward. Maybe easy wasn't the right word. Straightforward is. Payroll. Payroll is what we pay to our employees for working. Hopefully you all know that, right? That's what we pay to our employees for work, payroll. There are a couple of things related to payroll. Payroll taxes and other benefits. And benefits and taxes. Those are the two primary things that come out of payroll. When we talk about payroll, salary is usually for a fixed annual amount. That's salary, usually for management and administrators. Wages are hourly wages, hourly employees. So salary employees, those are your managers and above, and your administrators or anyone else on a fixed annual income. Wages are referred to as hourly employees. They're typically paid weekly, bi-weekly. And of course, in addition to both employees are typically eligible for bonuses, commissions, profit sharing, cost of living adjustments, so forth and so on. Overtime. Overtime is time and a half in the United States for every hour worked over 40 hours. Here's an example of a payroll check and how it's calculated, okay? And this is just raw payroll. This is before any deductions for taxes and so forth and so on. Regular earnings, this is an hourly employee. Their hourly rate is $34 per hour. This employee looked like they worked 42 hours in a week. So $34 times 40 is 1,360. That's their regular rate. Now in the United States, overtime requires time and a half for payment. So $34 times 1.5 is the overtime dollar per hour. Okay. So 34 times 1.5 times 2 hours is $102. So that obviously tells you that the employee overtime is $51 per hour. That's their hourly rate for overtime. Total earnings, 1,462. So you take regular earnings plus overtime earnings, 1,462 for this employee. Now let's talk about their paycheck. How does it look? Gross pay. This is your regular payroll plus overtime plus other things before deductions. That's called gross pay. Gross pay. Then you have net pay. Net pay is gross pay minus all of your deductions. Gross pay minus federal tax, minus state tax, minus local tax, minus medical insurance, minus contribution for retirement, minus other deductions, right? Then you arrive at net pay. Income taxes. Income taxes are paid for by both the employer and the employee. We both pay taxes. The company pays taxes, the employee pays taxes. In fact, required by law that the companies in the United States match federal taxes. Okay. Income taxes. On your W-4, when you're first hired, you declare dependents, you declare additional allowances, you declare your withholdings. Yeah, that's the idea behind a W-4. Hopefully you've all seen one at one point in your lives. The IRS is our friends that determine the rates, unfortunately. I'm not a fan. Employers have to pay this thing called FICA. So Federal Insurance Contributions Act. FICA taxes help to guarantee Social Security for retirees and Medicare for health insurance for senior citizens. That's how those things are paid. You paid into it, and so did your employer. Okay. And so you paid into Social Security, so did your employer. That's where the match comes in. That's what I was talking about earlier, the federal match. So your employer paid into Social Security, so did you. You paid into Medicare, so did they. Okay. Here are the rates. The rates are determined by your fund folks at the IRS. 6% on all earnings for Social Security, 1.5% for all earnings on Medicare. It might be a little different now, but that's what it was at the time of this this slide was made, which I think was a few years ago, so it probably changed. Okay, so looking at our employee from earlier, they earned $1,462 in gross pay, right? 6% goes to Social Security. So the employee had to pay $87.72 to Social Security. Medicare, well, both the employer and the employee had to pay that amount. Medicare, 1.5%. 1462 times 1.5, they had to pay $21.93 to Medicare. The total FICA withholdings is $109.65. And then there's other deductions that the employees typically have: retirement savings, charitable contributions, life insurance, childcare, yada, yada, yada. The list goes on, right? Those are typically pre-tax. Those are before taxes. So here's an example from our employee. Gross earnings for 1462. Social Security 8772. Medicare 2193. Federal income tax, they had to pay $257.95. They contributed to their retirement $20, and they donated $5 to United Fund. Their total deductions were $392.60. Gross minus total deductions equals net pay, $1,069.40. And that's how our payroll is calculated. It's straightforward. The only real difference is that the employers, they must match the Federal Insurance Compensation Act for the FICA taxes, but they must also pay federal and state unemployment compensation. So in addition to the employers paying into your Social Security and into your Medicare, they also have to pay federal and state unemployment insurance. And those liabilities are recorded and remitted typically every month. Yeah? So here's an example from the company's side of things. We had sales salaries of $20,000, office salaries of $5,000. Total payroll for the month or for the 2 weeks was $25,000. $25,000 is subject to Social Security and Medicare, and $10,000 is subject to federal unemployment taxes. Social Security is 6%. Medicare is 1.5%. State unemployment tax is 5.4%. Federal unemployment tax 0.8%. Those rates have, I believe, changed in the past 2 years. Employee deductions, federal income, state income, retirement, and charitable. And so the company makes this massive journal entry every 2 weeks. And yes, that's true. We do this every 2 weeks. Debit office salaries expense, debit off sales salaries expense. You credit all of your payables. Remember, a payable is a current liability for the company. These payables are then remitted to the respective taxing agencies. Social Security, Medicare, federal, state, retirement, charitable, and then we debit salaries payable. The salaries payable, that's the net pay to the employees. Employers must match employees on Social Security and Medicare taxes, and then employers are the only responsible for state and federal unemployment taxes. So for our employee that made, or for our employees that made the 25,000 for the 2 weeks, 25,000 times 6%, 25,000 times 15%. The cap for unemployment is at 10,000. 10,000 times 5.4%, 10,000 times 8%. Total payroll taxes paid by the employer for the 2 weeks is $2,495. So we debit payroll tax expense and we credit the respective taxes payable for each taxing agency. Social Security, Medicare, state, and federal. And of course, then we end up paying that out, right? And to pay that out, you would debit those payables and credit cash, just like you would with any other payable. Employees also receive fringe benefits that the employer pays, such as vacation pay. When vacation pay is accrued, we debit vacation pay expense and we credit vacation pay payable. Typically we do that every 2 weeks, just like everything else. When the employee actually takes their vacation pay, then we debit vacation pay payable and credit cash to the employee. Pensions are cash payments for retired employees. Obviously, not all employers have pensions. That is a nice benefit to have. It basically is a fixed payment that the company makes for retired employees. Defined contribution plans, these are your 401ks, your 403bs, so forth and so on, right? These are retirement plans that are offered by the employers to the employees. The employer and the employee typically pay into these funds. Here's an example of such payment. Our company is paying pensions to the employees, 10% of the 401k plan paid to employees. Pensions, we debit pension expense to increase pension expense paid out, and we credit cash to represent the payment of cash. Defined benefit plans are formula driven. I definitely don't go that deep into the accounting aspect. That is way too difficult to understand. You'll probably run into something like that if you end up going into one of the higher level courses. I believe advanced accounting does cover payroll a little bit deeper. It gets very, very muddy. That's why I'm not a benefit administrator. I couldn't do that job. Here's a payment that the company made to the pension, debit pension expense, credit cash, and credit unfunded pension liability. This is in the event that the pension fund has a deficit, and that happens from time to time, unfortunately. And that, my friends, is the end of our presentation today. Joe, Rod, any questions, comments, concerns? Anything that I could help to address?
No, thank you.
You're good? Okay. I hope you liked it. Very cool. Rod, are you doing all right?
Yeah, we do. Great presentation.
Awesome. Thank you so much. I appreciate your kind words. Yeah, anytime you guys need help, you know how to get me. You got my email, my phone number. You could set up office hours. Anytime you need to talk, I'm here. So as always, I will post the PowerPoint presentation and the recording to the classroom and discussion area. With that, I want to thank Rod and Joe for your time today. I apologize for going 26 minutes over, but again, I feel that these sessions are helpful and beneficial for your progress and for helping you out on the homework assignments. So with that, thank you both so very much for your time. For the rest of you, please make sure that before you take your homework assignment, my recommendation, as always, is to please try that self-assessment first. Self-assessment. Actually, this week doesn't have. Well, no, it does. It does. Try the self-assessment. The self-assessment, actually, no, this week does not have one. So I apologize. There is no self-assessment for this particular week. But my recommendation, watch this video, go through the PowerPoint presentation before attempting the homework. It'll definitely help you. I promise you it will. And with that, if there's any comments, questions, or concerns that come up, please feel free to get me on the discussion boards, email me, call me, set up office hours, whatever it takes. And thank you all so much for your time. I appreciate all of your hard work, and let's get after it. Thank you so much. Take care.
Go on.
Thanks so much, Rod. I appreciate you.